Good day, everyone, and welcome to the 25th installment of the Algonic Beginner Tutorial Series. Over the past several modules, you've learned about candlesticks, how to read individual candles, recognize patterns, and understand the psychology behind each formation. You now know how to look at a chart and see the story of buyers and sellers battling for control. But today, we're going to talk about something even more fundamental. Something that exists beneath the candles, shaping every movement they make. I'm talking about the invisible structures that organize price movement, support and resistance. Here's a simple way to think about it. Imagine price is a ball bouncing in a room. The ball hits the floor and bounces up. It hits the ceiling and bounces back down. The floor and ceiling don't move. They are fixed boundaries that contain the ball's movement. Support is the floor. It's a price level where falling price tends to stop and reverse upward. Buyers step in. Demand overwhelms supply. Resistance is the ceiling. It's a price level where rising price tends to stop and reverse downward. Sellers step in. Supply overwhelms demand. Why does this matter? Because support and resistance work in all time frames and all markets. They are among the most reliable concepts in all of technical analysis. They give you clear, actionable levels for entries, exits, and stop placement. And they reveal where large institutional players, banks, hedge funds, central banks, place their orders. By the end of the session, you'll understand the psychology behind these levels, how to identify them on any chart, how to trade them effectively, and how to avoid the common mistakes that trap beginner traders. Let's begin. Let's define these two concepts clearly and understand the psychology behind them. Support, the floor. Support is a price level where demand, buying pressure, is strong enough to overcome supply. When price falls to a support level, it tends to bounce back up. Why does support form? Several types of traders converge at these levels. First, value buyers who miss the last move up. They see the price returning to a level where it previously found buyers, and they step in. Second, previous buyers who got in at or near the support level. They see price returning to their entry point and add to their positions. Third, short sellers who sold earlier. When price falls to support, they take profits by buying back their short positions. That buying activity adds to the upward pressure. And fourth, limit buy orders simply cluster at these levels. Many traders set buy limits at support, creating a wall of demand. Resistance, the ceiling. Resistance is a price level where supply, selling pressure, is strong enough to overcome demand. When price rises to a resistance level, it tends to bounce back down. The psychology is symmetrical, but opposite. Profit takers who bought at lower levels see price returning to a high where they can exit with a profit. Traders who bought near the top get a chance to break even and may sell to get out. New short sellers see the level as a good place to initiate short positions. And limit sell orders cluster at resistance, creating a wall of supply. The key insight here is that support and resistance are not arbitrary lines drawn by analysts. They represent real clusters of orders placed by real traders. They are where the battle between buyers and sellers is most intense. Now, let's go deeper into the psychology. Why do support and resistance actually work? The answer is something called the self-fulfilling prophecy. Markets don't have literal memory, but traders do. Previous turning points become reference points for future decisions. When enough traders watch the same level, their collective action makes that level meaningful. At support, the buying pressure builds. Let's walk through what happens as price approaches a support level from above. Value buyers look at the chart and say, "This level bounced before. It's a good place to buy again." They place buy orders. Stop hunters know that many traders place stops just below support. They may try to push price through briefly to trigger those stops, then buy at a discount. This activity can actually strengthen support after a brief fakeout. Short sellers who sold at higher prices see price falling to support. They say, "Time to take profits." They buy to cover their short positions. The net effect of all this buying pressure is that support holds and price reverses upward. At resistance, the selling pressure builds. Now, let's look at what happens as price approaches resistance from below. Profit takers who bought at lower levels see price approaching a high where it reversed before. They say, "I'll take my profits here." Traders who bought near the top and have been waiting to break even see price coming back to their entry. They sell just to get out. New short sellers see the level holding and say, "This is a good place to short." The net effect is that selling pressure builds and resistance holds. The self-fulfilling prophecy is powerful. Support and resistance work, in part, because so many traders believe they will work. Their collective action, placing orders at these levels, creates the very price behavior they're expecting. This doesn't make the concept invalid. On the contrary, it makes it more reliable. As long as enough traders are watching the same levels, those levels will continue to influence price. Now, let's get practical. How do you actually identify support and resistance levels on a chart? First, let's understand the different types of support and resistance. Horizontal levels are the most common and reliable. You draw them straight across the chart at price levels where reversals have occurred multiple times. These levels are stronger when they are visible on both the daily and weekly charts. Diagonal trend lines are drawn by connecting at least two higher lows in an uptrend or two lower highs in a downtrend. You then extend that line into the future. These are dynamic. The line moves with price. Dynamic support and resistance comes from moving averages. The 20-period exponential moving average, the 50-period moving average, and the 200-period moving average are commonly used. Many institutional traders use these for entries and exits. Because the averages move with price, they provide a trailing level of support or resistance. Psychological round numbers are critical in Forex. Levels like 1.1000, 1.2000, and 150.00 attract orders simply because they are round numbers. The most important are 0.0000 levels, like 1.1000. The next most important are 0.0050 levels, like 1.1050, and then back to 0.0000 again. Here is a simple 5-step process to identify key levels. Step 1. Zoom out. Start on a higher time frame, daily or weekly. You need to see the big picture before you drill down. Step 2. Look left. Scan the chart for areas where price reversed sharply. These are your candidate levels. Step 3. Mark obvious levels. Look for clean, clear touches, not every minor wiggle. If price bounced off a level 3 or 4 times, that's significant. If it just touched once and moved on, it may not be. Step 4. Note round numbers. Add the psychological levels near your identified areas. Step 5. Draw zones, not lines. Shade the area of congestion rather than drawing an exact line. Price rarely reverses at the exact same price twice. It reverses in a zone. Not all support and resistance levels are created equal. Some are stronger than others. Let's talk about the factors that determine strength. First, the rule of touches. The more times a level is tested and holds, the stronger it becomes. Why? Because more traders remember it. More orders accumulate there. One touch is just a potential level. It needs confirmation. 2 touches suggest a possible level, gaining significance. 3 touches gives you a valid, confirmed level. 4 or more touches creates a strong, significant level. However, there's a caveat. Very old levels that were tested many times but haven't been touched in years may eventually weaken. Market participants change. Orders expire. Context matters. Second, time frame hierarchy. A support level on a monthly chart is far more significant than one on a 5-minute chart. Higher time frames represent more data, more volume, more participants, and more money. Here's the hierarchy. Monthly levels are the most significant. Weekly levels are very significant. Daily levels are significant for swing trades. 4-hour levels have moderate significance. 1-hour levels are short-term. 15-minute and 5-minute levels have minimal significance. When you're trading on a lower time frame, always mark the higher time frame levels first. They dominate. A 5-minute support level means very little if price is sitting on a daily resistance level. Third, confluence. Confluence is when multiple factors align at the same price level. This is where the magic happens. Imagine you have a horizontal support level from 3 previous bounces. At the same price, you have the 200-period moving average. And it's also a round number, like 1.2000. And it aligns with a Fibonacci retracement level. And there's a trend line coming in at the same price. That's confluence. That's a high probability level. Here's a simple scoring guide. 2 factors at the same level gives you a good setup. 3 factors is very good. 4 or more factors is excellent. Don't trade levels in isolation. Look for levels where multiple reasons converge. One of the most powerful concepts in technical analysis is role reversal. When a level breaks, its role often flips. Let me explain. When a support level is broken, price falls through it. That same level often becomes resistance on subsequent rallies. Price returns to the level from below, and now the level pushes price back down. Why does this happen? The psychology is fascinating. Traders who bought at the support level expecting a bounce got stopped out when price broke lower. They now want to sell when price returns to their entry to get their money back. Traders who sold short on the breakdown see price returning. Some add to their shorts. Others set stops just above the level. The net effect is that selling pressure accumulates right at the old support level. The opposite is also true. When a resistance level is broken, it often becomes support on subsequent pullbacks. The trading implication is clear. When a key level breaks, don't assume the move is over. Look for the broken level to be retested. Enter in the direction of the break on that retest. Place your stop just beyond the broken level. Now, let's talk about zones versus exact lines. Here's a truth that many new traders struggle with. Price rarely reverses at the exact same price. More often, it reverses in a zone. An exact line approach gives you clear entry and stop levels, but price may never hit your exact line. A zone approach is more realistic. It acknowledges that support and resistance are areas, not mathematical points. Here's how to draw zones. Step 1. Identify the area. Look at the chart and find where multiple touches occurred. Don't look at a single price. Look at a range. Step 2. Note the range. Mark the highest high and lowest low of the congestion area. That's your zone. Step 3. Shade the zone. Highlight the entire area. When you're trading, you expect price to reverse somewhere within this zone, not at a single line. For example, a support zone might be from 1.0950 to 1.0960. You might place a buy limit at 1.0955 in the middle of the zone. Your stop goes below the zone at 1.0940. Your target is the next resistance zone above. This approach is more realistic and will keep you in trades that an exact line approach would miss. Now, let's put it all together. How do you actually trade using support and resistance? Bullish setups at support. There are 2 main approaches to trading support. The bounce trade. You wait for price to reach the support zone. Then you wait for a bullish candlestick pattern to form, a hammer, a bullish engulfing, or a morning star. You enter on confirmation from the next candle. Your stop loss goes below the support zone, typically 5 to 10 pips below, or 1 ATR, average true range. Your target is the next resistance level above. The limit order. If you're more aggressive, you can place a buy limit order just above the support zone. You're anticipating that price will bounce. Your stop goes below support. Your target is the next resistance. Which approach is better? The bounce trade with candlestick confirmation has a lower win rate but better risk-reward because you're waiting for confirmation. The limit order has a higher potential reward but also higher risk because you're entering before confirmation. Choose based on your trading style. Bearish setups at resistance. The bearish approach is the mirror image. The bounce trade. Wait for price to reach the resistance zone. Look for a bearish candlestick pattern, a shooting star, a bearish engulfing, or an evening star. Enter on confirmation. Stop above resistance. Target the next support below. The limit order. Place a sell limit just below the resistance zone. Stop above resistance. Target the next support. The key insight is this. Support and resistance levels tell you where to look. Candlestick patterns tell you when to enter. The combination is powerful. A bullish pattern at a strong support level is a high probability setup. A bearish pattern at a strong resistance level is equally powerful. Never enter at a level without candlestick confirmation. A level alone is not enough. Wait for the candles to tell you that the level is holding. Not every touch of a support or resistance level leads to a bounce. Sometimes price breaks through. These are breakouts. But not all breakouts are real. False breakouts, called fakeouts, can trap traders who enter too early. Let me show you how to distinguish between valid breakouts and fakeouts. Valid breakout. A valid breakout has several characteristics. First, the candle closes beyond the level. Not just a wick that pokes through, the close is on the other side. Second, volume is higher than average. Real breakouts attract participants. Fakeouts don't. Third, a valid breakout often retests the broken level. After breaking resistance, price may return to that level from above. The level that was resistance now acts as support. That retest is often the best entry point for a breakout trade. Fourth, there is follow-through. Price continues in the breakout direction toward the next level. Fakeouts, false breakouts. A fakeout occurs when price moves beyond a level but immediately reverses. Traders who entered on the breakout are trapped as price quickly moves against them. Fakeouts often happen during low volume periods or before major news events. They can also be engineered by large players to trigger stops before moving in the opposite direction. How to avoid fakeouts. Technique 1. Wait for the close. Don't enter the moment price touches beyond the level. Wait for the candle to close. If it closes beyond, the breakout has more credibility. Technique 2. Use confirmation. Don't enter on the breakout candle alone. Wait for the next candle to confirm the direction. Technique 3. Check volume. A breakout on low volume is suspicious. A breakout on high volume is more reliable. Technique 4. Consider wider context. Is the breakout aligned with the higher timeframe trend? Breakouts with the trend are more reliable than breakouts against it. Volume tells the story. High volume at a level confirms that many participants are active there. It strengthens the level. Low volume on a breakout suggests few participants are involved. The breakout is likely to fail. Rising volume as price approaches a level suggests growing interest. The level is being tested seriously. Remember, support and resistance levels are not absolute barriers. They are areas where battles are fought. Sometimes the battle ends quickly. Sometimes it takes multiple attempts. And sometimes the level breaks. Have a plan for both scenarios. Even experienced traders make mistakes with support and resistance. Let me walk you through the 6 most common traps so you can avoid them. Mistake 1. Drawing too many lines. This is probably the most common mistake. A trader marks every minor wiggle, every small reversal, every little bounce. The chart becomes a mess of lines, and none of them are meaningful. The fix is simple. Focus on significant, tested levels only. Look for levels where price has reversed multiple times. If a level has only one touch, it's not a level yet. Cluttered charts obscure the real levels that matter. Mistake 2. Forcing lines. Sometimes traders want a trend line to exist so badly that they force it, drawing a line that doesn't really connect cleanly to the price points. The fix: if the line doesn't connect naturally to the highs or lows, it's not a valid line. Be objective. Let the chart speak to you. Don't impose your will on the chart. Mistake 3. Ignoring higher time frames. A trader finds a nice support level on a 15-minute chart and enters a trade, but they never looked at the daily chart. The daily chart shows price sitting just below a major resistance level. The fix: always mark higher time frame levels first. Start with monthly, then weekly, then daily. These levels dominate. A 15-minute support level means very little if price is at a daily resistance level. Mistake 4. Exact lines only. A trader expects price to reverse exactly at 1.10000. Price comes down to 1.10005 and reverses, but the trader didn't enter because it wasn't exactly 1.10000. The fix: use zones. Price rarely reverses at the exact same price. A support zone from 1.0995 to 1.1005 is more realistic than a single line at 1.1000. Mistake 5. No stop placement. A trader enters at support because support should hold, but they don't place a stop loss. Then support breaks, and the trader takes a much larger loss than necessary. The fix: always place a stop loss beyond the level. Support can break at any time. A stop 5 to 10 pips below support protects you. Without it, you're gambling. Mistake 6. Assuming levels never break. A trader holds through a clear breakout because this level has held 3 times before, it should hold again. The fix: have a plan for both scenarios. If the level holds, you trade the bounce. If the level breaks, you either exit or trade the breakout. All levels break eventually. Be prepared. Recognizing these mistakes is the first step to avoiding them. Review this list before every trading session. Let's bring everything together into a complete framework you can use on every trade. Your support/resistance checklist. Before entering any trade based on a level, ask yourself these 5 questions. 1. Have I checked higher timeframes first? Identify the major levels on weekly and daily charts. These are your most important references. 2. Have I added all key levels? Horizontal support and resistance, trend lines, moving averages, psychological round numbers. The more completeness, the better. 3. Is there confluence? Multiple factors at the same level create higher probability. 2 factors is good. 3 is very good. 4 or more is excellent. 4. Are there candlestick patterns at the level? Look for confirmation. A hammer at support. A shooting star at resistance. An engulfing pattern. Volume confirmation makes it even stronger. 5. Do I have a plan for both scenarios? If the level holds, you trade the bounce. If the level breaks, you trade the breakout or exit. Stops in place either way. How Algonic helps you put this into practice. You don't have to draw every line manually or stare at charts for hours. The Algonic platform includes powerful tools that automate this work. Auto-level detection identifies key support and resistance levels across multiple timeframes automatically. You don't miss important levels. Multi-timeframe display shows higher timeframe levels directly on your lower timeframe charts. You always see the dominant levels. Confluence scoring highlights levels where multiple factors align. The platform does the math for you. Breakout alerts notify you in real time when key levels are tested or broken. You never miss an opportunity. Community levels let you see what other algonic traders are watching. This can confirm your own analysis or alert you to levels you missed. Journal integration tracks how levels perform over time. You'll learn which types of levels work best for you on which pairs. Putting it all together. Here's your workflow. First, open your Algonic tool on your trading platform and let the auto-level detection identify key levels on the daily and 4-hour charts. Second, review the confluence scoring. Focus on levels with multiple factors. Third, drop down to your trading time frame, maybe 1 hour or 15-minute. Fourth, wait for price to approach a key level. Watch for candlestick confirmation. Fifth, execute your trade with proper risk management. Stop beyond the level. Target the next level. Sixth, record the trade in your journal. Note whether the level held or broke. Over time, you'll build a record of what works for you. Let me leave you with this final thought. Support and resistance are where battles are fought. Every rally is a battle between buyers who want higher prices and sellers who want lower prices. Support and resistance show you where those battles have happened before and where they will happen again. Learn to read these levels. Learn to identify them on any chart, in any time frame, in any market. Find the floor and the ceiling, and you'll know where price will bounce. Thank you for your attention. I'm happy to take any questions.